for today's session, a few things. We're going to be going over Starbucks, and specifically, we're going to talk about creating a bull, a bear, and a target share price to follow on the as-is that we did last week. I posted a copy of the as-is model from last week if you had any trouble creating it for the last two homework assignments in the Starbucks folder. It's called Valuation Model SBucks as-is.xlsx. And as somebody pointed out to me, that's the model I'm going to use starting in the class. It differs slightly from what was on the video for homework 8, which won't affect the grading. But basically what happened was when I recorded it in one of the sections, somebody called out a number which I'd asked them what the G needed to be as I was typing it in, which was actually the wrong G. And I put it in, and when I was being recorded video, I didn't check that they were actually $1 off from the share price matching, as opposed to the correct share price, which I had in the earlier section, because I just trusted that the student had the right answer, which they didn't, but that's okay. So the point is, the video was actually $1 off, and that's what caused the video to be $1 off. But if you were within $1, that's all that's necessary to do the as-is. Okay, so the file that I'm showing you has the correct matching share price that's actually in the as-is model that is in Canvas today. All right, but either way, it won't matter because when we do the changes to the valuation, we'll be changing these files as well. But nonetheless, that is the file that we'll use as our official model for Starbucks. All right, so while you're getting that ready, I also want to mention that Wednesday, the first half of the semester for StockTrack ends. All right, so two things you need to do. One, I need to verify all of the StockTrack teams that are in each one of the sections, because your performance is going to be graded based on the teams in your section, not across teams in other sections. So I put up a very simple assignment, and it's in the Assignments tab. Specifically, it's in the one called Groups Project, which I called StockTrack Team Name. All right, so I just need one of your team members to go into there and say, here's our StockTrack team name, here's the section I'm in, and here's the person on my team who registered the StockTrack account. Okay, so that way when I print out the list of StockTrack companies, I'll be able to match that company with your team name for grading purposes. Okay, so I just need, preferably by today, because I'd love to tell everybody who is in your section that you're actually competing with, but nonetheless, I'll need that definitely by Wednesday. So please just have somebody in your team submit that information. So StockTrack team name, the person that's registered for StockTrack with that team name, and which section you are in. Okay, and so that way I can again match it back to the project team group. So please make sure you do that. So here's how StockTrack is going to work. You don't have to do anything, but on Thursday, the trading period ends on Wednesday for the first half of the semester. So on Thursday, I will go to StockTrack and I will print and download a ranking. Okay, and so that ranking will determine your first half of the semester grade on StockTrack based on your relative performance against the teams within your section. So it's based on portfolio value, so you don't have to liquidate anything. It'll just look at the portfolio rankings. Now the rankings are done every night, so basically I'll see it on Thursday, and that'll be the rankings that I use. And by the way, if you want to check it on Thursday, you're welcome to as well. I'll probably put up a PDF file, but essentially it will then determine the grades. The other part of the StockTrack assignment, which is due Friday, and again it's team, is the StockTrack write-up. Okay, so what you have to do is for every transaction you made, buy, sell, short, cover, you have to do a 1 to 2 sentence explanation of why you did that trade. What was your rationale? Okay, so it doesn't have to be overly long, but it has to be exactly why you did it. So for example, I bought this company because I thought that earnings were about to come out and this company was going to beat earnings. That was a good time to buy. Like, that's all you'd have to say. So it doesn't have to be overly long, but it has to be a rationale. And by the way, if you did multiple sells, like let's say I bought something and I sold it 3 times, well then each one of those sells has to be written up. Right? I sold this amount because of this, I sold another amount because of that, etc. So make sure you write it up. Now if you got a dividend or a stock split or anything like that, those you don't have to write up because those have nothing to do with what you did. So it's the transactions that you made. Make sure that you did at least 10 of them by Wednesday, and make sure you submit the write-up. The easiest way to do this is if you go into StockTrack, one of the options is to export a transaction log. So I'd almost put the transaction log, you can even put it in Excel, and then just literally write it out after each one of the columns, right? Of basically, here's why I did the transaction. Or you can put it into Word, right? But it'll give you the transaction log, and it makes it easy to write up, right? So questions about the write-up. So the way it works is it's due on Friday. It's a team write-up, so only one person on your team is actually going to be submitting it. They're submitting it on behalf of the whole team. And so the way the write-up works is if you don't submit the write-up, then you get a 0 on StockTrack, the whole team. So make sure that whoever's responsible actually submits it. Otherwise, the rest of your team is going to be tracking you down, all right? Because they're going to be really angry with you. Yes? You're going to submit it through Elms, and it's going to be right here where it's called StockTrack Part A. So it'll be a team-based submission. I haven't made the link active yet, but you'll basically submit your write-up right there. Okay. So again, the write-up is independent of the grade, meaning you'll get the grade based on relative performance. I'm going to presume that you did the write-up. As long as you do the write-up, that will be your grade. If you don't do the write-up, I'll go back in and I'll change it back to a 0. Now, there's a second part of StockTrack for the rest of the semester, but here's the thing. We're not resetting everybody. For the second part of the semester, you're going to continuing on with the current portfolio. So if you're in first place today, you start in first place for the second half of the semester. If you're in last place today, you start in last place for the second half of the semester. So the second half of the semester is cumulative, right, of the first and the second half. Right, so we're not resetting back to 0 for the part 2 of the semester. Okay, and then there'll be a final write-up at the end of the semester. So, questions about StockTrack? Yes?
So the write-up's due on Friday, but it's due on Wednesday.
I'm going to switch that to Friday. Does it say Wednesday in here? Before I forget. So StockTrack Part A. Thank you for pointing that out. So this is also on the video. I am going to change this to Friday. So the submission is a group project. At 5 p.m. Eastern Standard Time on Friday. Thank you for pointing that out. But it is going to be Friday. Other questions? Yes?
How's the grading work? Like roughly?
StockTrack?
Yeah.
So if you're in first place, you get 5 points. If you're in second place, you get 4 points. If you're in last place, you get 1 point. So it's just a relative scale based on the teams. And it doesn't matter how much you're in first or second by, it's purely just rankings. So no different than if this were a real world and you were running a hedge fund. Okay. The only difference is if you're running a hedge fund, you're in last place, you get fired. But other than that, here's just a little bit of your grade. So it's not nearly as bad. All right, questions? All right, so today, as I said, what we're going to do is we're going to work on the stock price target model of Starbucks. So again, you'll see it in the file section under the SBucks folder. And what we had done, I'll pull this up, is last week we did the as-is valuation of Starbucks to a stock price of $53.28. Okay, and so you needed to come in within $1 of that share price for the as-is. So what I want to talk to you today about, as I said, is the another 3 models: the target, the bull, and the bear. Which, by the way, everything we're doing today will be your next homework assignment individually that you'll have to work on this week. Okay, so make sure you're following along and don't have any questions, because this is the Bloomberg Lab assignment for Wednesday, okay, with a different company. So following along on this process. So before I start this, I want to also mention that I posted to Elms another folder called MSCat, which has 2 files in it. And last fall, I had Nicole DeBlas, who is the sell-side analyst for Morgan Stanley that covers Caterpillar and the global heavy construction equipment industry, guest lectured in this class. And she provided us with a PowerPoint file, which there's a copy of it, and her actual model for CAT that they had created that they use at Morgan Stanley for their sell-side research model. So I wanted to show you what a sell-side research model actually looks like. So here's the point. One of the things they talked about as a best practice was how increasingly on Wall Street, when they're doing their sell-side research, instead of just giving a target stock price, they are increasingly giving a range. All right, and that's where the idea of the bull and the bear comes from. And so I want to talk to you about that today, but more importantly, I want to show you a couple highlights from her presentation that will help give some additional context to what we're doing. So, in her presentation, make this full screen. But a few things, actually harder. Few things. One, when a Wall Street firm does sell-side research, it's usually a team of 3 people. Okay, so Nicole did this stick figure chart of her team. She was the me, and then she has 2 analysts that work for her. So one of the analysts, what happened to those screens? One of the analysts will probably be an MBA, the other might be an undergrad, but basically these are the people that are assisting in creating the models and the research and the recommendations for, in this case, Caterpillar, right? And when a sell-side research person does stuff, what the analysts spend their time on is about 1/3 of their time is on what she calls industry research, which earlier in the semester is what we call EIC. Okay, so again, they really spend a lot of time understanding the economic environment, understanding the industry, understanding the competition, understanding industry market share, margins, etc., to help them create their forecast. They also spend about 30% of their time talking to investors, right, which is another big deal for them because essentially they're selling their research to investors, so they got to basically constantly talk to these investors about what's going on with the industry. But they also spend some time building out the models, which is what we're doing here today. That's about 5% of their time. And then 15% of the time writing research. And you see what looks different if you were to be hired as a research associate. But one of the things that the sell-side analyst also controls is their coverage universe. So they actually determine at the firm which competitors that they're going to cover. So some analysts will have a larger coverage universe. Some analysts could choose a smaller coverage universe. Most of them are usually in the 10 to 15 range. I think you can see Nicole's was about 15, and that's pretty typical. But nonetheless, their job is to know everything about the industry, and then they specialize in writing research report on those companies. But there are some times that they won't cover every company in an industry. But that is really up to the firm and then the analyst that is in charge of that sector. And that she goes through, and this PowerPoint presentation is up there, but she goes through everything that you need to know about the company, which means doing a lot of your homework. So going through the research reports, going through the annual reports, going through the management reports, reading through all the conference calls, conference notes information, getting other information about the company, going through the website, going through proxy filings, looking through blogs on the industry, and then getting a better understanding of what's happening with the company. So, for example, when they build out a financial model, one of the things that they do is they look at the macro environment. So they look at economic data. So here is some economic data on what's happening with the global construction industry. Now, in the case of Morgan Stanley, they have an internal group that actually puts together the economic forecast. But in our case, we're going to use data from, for example, Bloomberg to help us with that. Then what they're going to do is they're going to forecast end markets. So, for example, they're going to look at all of the peers and all of the segments that they're selling to. So in this case, I could look at construction equipment versus infrastructure equipment sales versus agriculture sales versus oil and gas sales. So they're looking at the major segments that they're selling to. And then, for example, they put together a table that looks like this so they can see for the peers of the industry and for the segments who's competing where. Because eventually I have to understand the size of the pie, but then I understand the share of the pie, and I understand who I'm competing with in those market segments. So this is a way of framing who's competing where in the global construction industry. Because what they're then going to do is then they're going to do a forecast of revenue and margin by segment. Okay, so how big is, for example, going back a slide, the light construction market versus the heavy construction market in each region of the world, and how fast is that market growing in each region of the world. So it's not just a macro view, it is a little bit more of a micro view, right? So then they'll look at revenue by region, product sales by region. They'll look at, for example, the various market shares, the competitors in each one of those regions, and then they'll look at sort of share and revenue for the different parts of the world. And then here's one of the interesting insights she brought in, which is if we were doing, as we talked about briefly, oil and gas, like a Chevron or an Exxon or somebody like that, then the price of oil is a big indicator of performance in the industry. Well, the same thing is true for construction equipment. So basically, construction equipment sales are very highly correlated to construction spending. So that's another key input that's part of the macroeconomic data that's going to be very key to understanding what happens in the industry. So back to the EIC framework, linking it back to a key driver that's going to drive performance, right? And then looking then at U.S. construction fundamentals, and then how are they changing over time? What is the forecast? Because that is going to influence the forecast for revenue for companies like CAT, right? And then, for example, dealer inventory, because CAT is selling through dealers, and so if the dealers have too much inventory, even if, for example, demand picks up, then is the inventory going to pick up at the same rate that you're going to be selling to them, because maybe they're awash in inventory. There's going to be a lag in demand growth for CAT because the dealers have a bunch of inventory. Or flip it around, maybe there's not a lot of global inventory. So they look at that. And I'll skip in the interest of time to create segment forecasts for revenue and margin, which then leads to a detailed revenue forecast and then a detailed margin forecast, which then leads to a valuation. Okay? And speaking of valuations, this, as I said, is Morgan Stanley's valuation model. If it loads. Here we go. And what you'll notice, and it's a series of tabs, is their DCF looks a lot like there's an OPLAT, and there's basically a cash flow valuation. It looks a lot like ours, right? So, as a matter of fact, what's different is that they also include the concept of scenarios. So looking at, all right, across different WACs and across different growth rates. So for example, TG is terminal growth. That's the CVG in our model. What would be the share prices within a range? Okay. So again, it's a very similar process. But the major difference that I want you to understand is in the real world, they do a lot more diligence than what we're going to do in a 1-hour class in making these assumptions. So we'll say, Starbucks growth rate is 8.5%, but there's a lot of buildup to get an 8.5% forecasted growth rate. And they're making lots of assumptions along the way. So nonetheless, that's the major difference between what the pros do and what we're doing. Is the models are going to be very similar. The question is how we come up with the assumptions. And they're just doing a lot more homework on the assumptions. Right? By the way, the last thing I did want to show you, though, is that, and this is now an increasing best practice on Wall Street, which is when they talk to investors, you can see this here in the chart, and they come up with a DCF, the concept of ranges. So, for example, if you look on the upper right-hand chart here, what you can see right in the research report is here is the current share price, here is the target share price, and then here is the range, the bull and the bear, that the company could trade at. Because when you communicate to investors, what you want to get them to understand is, if I buy a stock, what's my upside and what's my downside risk? Okay? Because risk in finance is standard deviation. So how much of a range of variance do I get in a stock? So is it 56 and then the high could be 70 and the low could be 50? Or is it 56 and the high could be 80 and the low could be 20? Okay, so I kind of want to get a sense of what is the range of possibilities if things go really right or if things go really wrong for a company, as opposed to here's what I think it's worth. So that's what we're going to put into play this semester, right? So what that means is every time you complete an assignment, whether it's your group project or the assignment that's going to be due next Monday, at your Bloomberg lab on Wednesday, you're going to turn in 4 Excel models. Model number 1, as is. It's current share price. Model number 2 is going to be the bull case, which we're about to work on, which is if everything goes right, here's the top end of the range the company could be worth. Then you're going to do model number 3, which is going to be the bear case. If everything goes to hell in a handbasket and goes wrong, here's what the share price could be. Model number 4, where along the continuum do we think the company is going to end up? That is our target share price. Okay? And that will create the buy, sell, hold opinion. Okay? And speaking of which, you can see that in Bloomberg. So if we go to Bloomberg and we go to Starbucks, if you go to ANR, which is the analyst rankings, what you will see is as of today, 27 analysts rate Starbucks a buy. Right? And by the way, buys are worth 5 points. 6 analysts rate Starbucks a hold. Holds are worth 3 points. No analysts say sell. Holds will be worth 1 point. On a 5-point scale, Starbucks today is a 4.64 out of 5. A target share price is basically a 12-month target share price. All right, so that's what we're doing today. Is we're saying even though we're coming up with a fair value of Starbucks, we think that it could take up to 12 months for the company to reach that target price. All right? Because the idea is the market's not as perfect as people think. All right? So the average 19 analysts have put in guesses for target share price. The average is 66.37. All right? So Starbucks today is at 54. And you can see there's some difference of opinion. So for example, you have David Palmer of RBC has a price target of 64. You can see this guy, Matthew DeFrisco for Guggenheim, is very aggressive with Starbucks at 72 versus, scroll down the list. Here's somebody at Credit Suisse, Jason West, who thinks Starbucks is at 58. Here's another one, 58, which is very close to the current stock price. So generally, plus or minus 10% of the current share price is considered a trading range. Okay, so generally, if you're within 10%, some brokerages will go as high as 15, but generally plus or minus 10% is a hold. All right, because what you say is the company's fairly priced, it's going to bounce around a little bit, but nonetheless, there's not really a compelling reason to buy. So if you think about it, if Starbucks today is around 53, 54 a share, then 10% would be somewhere around 61, 60, 61. All right, so at 10% below would be around 49. So basically, somewhere between 49 and 61 is where I'm going to probably be in the hold range for Starbucks. And you can see that the people are 58. You can see that in yellow. Yellow is hold, which is another way of saying neutral in his case, or equal weight in the case of Stevens, Will Slaba, or whatever his name is, or even Stifel, which is Mark Stiefel, has a target price of 60. That's in the hold range. Whereas the people that are above 61 are in the buy range. So again, Nicole at Piper Jaffray, or Nick at Webbush, they're at 65, or Mark Suarez is at 70. They're in the buy range because they're in that more than 10% range in the next 12 months, versus the sells would be below 49. Nobody's there for Starbucks. Okay, so that's where the buy, sell, holds are coming from, and that will be part of your assignment. So what your assignment is going to be, so I'll preview it now, is you're going to turn in those 4 Excel models, and then you're going to write a Word document, minimum of 500 words, and you're going to explain your assumptions and rationale for coming up with each one of those 4 models. So paragraph, what were the assumptions you used in the as-is model to come up with revenue, to come up with G, to come up with EBITDA margin, and to come up with tax rate? And you're going to repeat that process 4 times. Okay, and you're going to write all that up with a final sentence. I think this company is a buy, sell, or hold based on my target share price because of the range that I just gave you. Okay, and so what's going to happen is at the end of class, actually end of day today, because I don't want the later classes to do this, I'm going to basically give you another company. It won't be Starbucks, and it won't be in this industry, and you will have to soup to nuts do everything that we have done. You'll have to do an as is, you'll have to do a bull, a bear, and a target, and you'll have to write it up. And it's an individual assignment, right? And by the way, as a reminder from last week, if you go to the FA section, you should have also have created your custom export for the model for 6 years, because you'll have to export and use the data for that company and bring it into your model, otherwise it won't work. So that's also, in a way, part of this assignment for this week. Okay, but before we get to the assignment, let's focus on finishing up Starbucks. So here's the first thing I want to do. I want to take the model where we ended up with last week, called the as-is model. So valuation model, Starbucks as-is. And then I want to, first of all, I want to come to this ROIC chart tab, and I want to wipe it out. Get rid of it. Right-click, delete. Okay, so I've killed that tab. And then I want to go to my EP/EOI tab, which is the end-of-year economic profit. So NOPLAT divided by end-of-year capital. And I want to take row 15, which is the ROIC for the 5 historical years, and for the 6 forecasted years, I want to select from 2011 through 2021 the ROIC. I want to create a new graph. Right? You can either create it as a blank sheet and put in the graph, or you can create it as your own sheet. So insert sheet, chart sheet. This is replacing the ROIC chart that we just deleted, because the ROIC chart that was in there only had the historical years. This has both the historical years and the forecast ROIC. Make sure you don't delete the ROIC table, like the tree. So don't kill the tree, kill the chart, and replace it with this chart. And by the way, make this a line chart. Okay? And it might be easier across the bottom to right-click, select data, and then for the horizontal axis labels, basically put in the years. Just so you know what year you're looking at. Right? But essentially what we've done is we've just created, and I'll once again call this the ROIC chart, which I'll then resave, which I'll give you the historical and the forecast ROIC. Now this is going to be a very important sanity check for the models that we're about to build. Okay? Because what you should have remembered from your reading in the book is what should happen to a company's ROIC over time in the out years. Well, what should we expect this chart to look like going forward? If we drew a line, how should the line look for ROIC? What should be our bias for a mature, established company like a Starbucks? Yeah.
It's converging towards its WACC.
You should see it converging towards its WACC. Because, and I'll bring up a PowerPoint file with 2 charts from the book. If I can figure out which one was PowerPoint. Here it is. So these were 2 charts out of the book, but this was a very important chart. And what it showed us was 2 things. One, the chart in the table on the left was basically industry ROIC and ranges of ROIC. But the table on the right said that McKinsey broke public company ROICs into quintiles based on actual ROICs of the company. And then what they did is they did a buy and hold strategy over time. And what they found, as she just mentioned, is ROICs tended to move towards the WACC over the long run. All right, so it's not just academic theory, it's actually observable data in the marketplace. So the top quintile of performers today will probably see their performance degrade over time. Right? And it's just Darwinian, meaning ultimately we're going to see companies go into mature stages and eventually decline in the product life cycle. We're going to see competition come up with new products. We're going to see technology evolutions in the marketplace. We're going to see changing consumer preferences. Nothing lasts forever. And that needs to be a very strong bias that we have as we value particularly mature companies. So you shouldn't expect ROICs to go up over time. You should actually see them go down over time. Now, there can always be exceptions to the rules, but it should still be our bias. And you see that today, meaning Apple. As well as Apple's been doing with iPhones, Apple is doing a little bit less well now. Why? Because they're seeing more competition from Samsung. Google just introduced the Pixel, and you're seeing a lot of cheap Chinese knockoff phones, which are much lower priced than the $900 iPhone, that are using either Android or other low-cost systems that are coming into the marketplace. And so basically it's great for consumers. Consumers are getting a lot more choice at lower cost. And so Apple is seeing less phone sales, and eventually they're going to start to see lower prices. So that's what I'm saying. It's even playing out for a company like Apple in the marketplace today. It's going to play out for Facebook. It's going to play out for Google. It happens to everybody eventually. So that needs to be our bias. What also should be our bias is that poor performers don't stay poor performing forever, right? Now, these are not startup companies, which most of them fail. These are publicly traded companies that have established business models. But even the poor performers see their performance not necessarily jump to the top quartile, but nonetheless tend to move towards their cost of capital over time. Because as I said, if I'm a poor performer, it's adapt or die. Because investors are selling me. They're not giving me capital. So I have to use what I do in a more efficient way. And companies often feel that pressure, and they do adapt, and they do get relative improvement of performance. So you do see compression towards the mean. Here's the other bias, which is the growth. That for big companies, growth compression to the mean, which typically McKinsey said historically has been about 5 to 6% when you include non-organic growth, think acquisitions. But basically, that compression happens a lot faster. And the number one reason, as explained in the book, is what they call the law of large number effect. Okay? So let's just think about Starbucks. If Starbucks is growing, is a $20 billion company, rounding off, and they're growing at 10% a year. Well, here's what that means. This year, 10% of 20 billion is 2 billion. But next year, 10% of 22 billion is 2.2 billion. The third year, 10% of 24.4 billion is almost 2.4 billion and change. So that's the point, is that as you get bigger, growing at the same rate gets harder. So what you end up seeing is growth rates compress much faster, more than anything else, because of law of large numbers. So we got to be careful when we say this company's going to grow at 10% a year for the next 5 years when they're already big. Now, if you're a small company, relative size, then that's easier to do. But when you get bigger, it becomes harder. So again, I'm not saying there's not exceptions to the rule, but as we think through our forecast, this should become some of our biases. So with Starbucks, this is a way to sanity check this, or for any other company. So going back to our model. So I would expect that this ROIC for Starbucks should probably start heading this way over time. And already today, even in the as is, we're seeing improved performance. So that means either one, they're gaining more competitive advantage, or two, they're getting into better markets and the better market conditions. All right, but nonetheless, we'd have to have a rationale for this. So, model number one, the bull. File, save as. I'm going to do SBucks bull video. So, here's the idea. What if everything goes right for Starbucks? Well, here was the assumptions we made when we did the as-is. So what needs to go right about the industry and the economy? Well, to help us, we need to know some stuff about the industry. So for example, one of the tools available to us on VBIC, go to VBIC, and kill out of this, which you can get off of Canvas. It'll open a new tab. Under Industry is something called IBIS World. And IBIS World does professionally industry research reports. So again, because this company is based on the real world, it's perfectly acceptable to use real-world industry reports to help you answer these types of questions, like what is the industry growth rate? The only thing is, don't plagiarize, okay? Cite. So it's perfectly okay to source other material, just don't call it your own, okay? So again, in this case, what you can do is you can type in an industry or a company. In this case, I'll type in Starbucks, and it will tell me the research reports that Starbucks is in. So one of the things I'll see is coffee and snack shops, as well as retail market for coffee, because Starbucks is increasingly selling coffee in grocery stores like Safeway, right, as an alternative to just selling it in traditional Starbucks stores. So nonetheless, I will look at coffee and snack shops, and then it basically gives me an industry analysis. So parts of the EIC, parts of the I, the E and the I, are actually written up in the IBIS reports and can give you a lot of insight for the companies that you're going to be analyzing, including Starbucks. But one of the useful features is this last tab over here called Key Statistics. And by the way, you can hit PDF and download this whole report. But this shows me industry size and, more importantly, industry growth rates that are being forecast. So if I look at coffee in the U.S., what I can see is growth rates from 17 through 21 in the 2 to 3% range per year. Okay, so that's what IBIS is predicting Starbucks U.S. market that it's going after is growing at, right? Somewhere in the 2 to 3% range. Then I can look at industry report number 2, which is what's happening with retail market for coffee. Key stats, again, 3, 3.5%, 2.9, 3.5, 2.6, 2.3, 2.9. That market's also growing in the 2, 3.5% range. Okay? So I say that because when we did the as is, we're at 8.5 for Starbucks, right? In a market that's growing at 2 to 3%. So that must mean they're gaining competitive advantage. Now, this was just the U.S. So here's another thing. If you go to Bloomberg, and if you go to the FA section of Bloomberg, which you learned in your certification, and you go to segments, then here is revenue by geography for Starbucks. And what you can see is in 2015, Starbucks revenue was about $19 billion. About $13 billion, or about 2/3 of it, came from the U.S. Right? So 2/3 of their sales are U.S. sales, which the U.S. market is growing about 2 to 3% a year. But $6 billion of their sales came outside the U.S. Matter of fact, look at China, Asia Pacific. It's gone from $500 million to $2.4 billion in 2015. And they had over $1 billion, almost $1.2 billion of growth last year alone, just in China, Asia Pacific. So if you think about Starbucks, part of the reason why they're probably growing at 8.5% is not because of the U.S. It's because of these other markets that they're going into, right, around the world, which they're growing much more rapidly. So nonetheless, and this is what I mean by Morgan Stanley, we should be thinking about, okay, what's the growth in the U.S., what's the growth in Asia Pacific, what's the growth in EMEA, is Europe, Middle East, and essentially how will that influence the opportunities for Starbucks when we think about the growth. The other thing that's happening in Starbucks, if you read the research reports, is they're also getting into higher end businesses. Specifically, what are they opening up? Anybody here been reading about Starbucks high-end stores? You know about it? No? Well, I don't. Are they selling wine bars? Okay, but basically, there's these really high-end coffee shops. You guys heard about this? They're going to put out 1,000 of them. They pilot them in Seattle, but basically, it's going to be. I don't know if there's. Maybe they're going to serve alcohol in some of these, but very high-end coffee, like super high-end. Not that a $4 latte isn't high-end to begin with, but I guess it'll be like a $10 latte or something. I don't know. I haven't been to the test stores. But nonetheless, premium experience, premium brews, premium food, premium seating. It's almost like a luxury store to hang out in. And more importantly, premium margins. Right? So they're looking at that as a way of growing. Matter of fact, they've also been experimenting with juice bars. Okay? So basically getting into the juice market in addition to the high-end coffee market and to some degree high-end food, which then leads to competition. So which competitors should we also get a sense of to understand in the marketplace? So who should be the competitors of Starbucks we might want to start looking at as well to see as we start thinking about the revenue and the margins that are able to be achieved in the industry. So who do you think are Starbucks competitors? Yeah, Dunkin' Donuts. Who else? You guys coffee drinkers? Where else do you get your coffee from? McDonald's? Increasingly McDonald's, which is also going after all-day breakfast because the traditional Starbucks stores are also starting to sell more food, particularly breakfast sandwiches, which they're expanding into, which is direct competition with McDonald's. So McDonald's, which is also going to premium coffee. Dunkin', who else? You guys don't get out much? I'm sorry? Maybe a Pete's, Seattle's Best, whatever those companies are. Who else? Yeah.
Coffee maker.
I'm sorry?
My own cup.
So to some degree, those, Nespresso, or how do you pronounce those?
Folgers.
Oh, Folgers. So traditional, okay, supermarket, other coffee. I was also thinking about Panera as another alternative to people going to Starbucks, particularly for the coffee house settings. But nonetheless, we get a sense of what their growth rates are, what their markets are as we do this. As I said, for time and simplicity, we're not going to necessarily do that today. But when you do your group projects, which will be, by the way, you're going to pick your group project company next Monday. Okay, so you will start your group project next Monday. Right, just FYI. And this is the type of analysis I expect your teams to start to get into. Okay, so it won't be very superficial. It's going to be far more detailed than we're doing with the model here today. But let's come back to this. So let's talk about the bull scenario. So back to Starbucks. If everything goes right, what could these numbers look like? So think about this. Right now, to get the current share price, we're talking about 8.5% growth. And if we look at historical revenue growth rates, it's been as high as 14 or 12, 11, 16. So let's say they get more sales in outside the U.S., and they get a lot more sales than is expected with their new stores. Complete smashing success. How high could these growth rates be? And when we do the bold, like I said, I'm not expecting a fantasy scenario that's completely unrealistic. I'm thinking about upside, very realistic. Maybe 12% a year? 13%? I mean, not unheard of. Call it 12. Or 12.5. Let's use 12.5. 12.5%. Okay, for the next few years. Now again, harder to do, but nonetheless, let's say they get to 12.5%. And let's talk about margins. Now, the next 2 years for Starbucks are the best the EBITDA margins have ever been. So already this premium strategy that we're talking about is probably influencing analyst expectations for Starbucks' overall margin. But let's say that they are able to shift their business a little bit higher end, and it actually shifts the margin for the company even a little bit higher. So let's say instead of 25.4, the margins get to 26.5. Okay? And then finally, let's say the tax rate gets to 29. Right? So I think we had said 32 on the original target by looking at the past years. But let's say as they go more internationally and they get better at tax planning, that last year is actually more indicative of a long-term tax rate that's going to be a little bit lower. So we'll put a 29% tax rate in there. Well, here's the idea. We're now at a $67 stock price, right? Which is into the bull range, right? But more importantly, or the buy range. But more importantly, this is a much more optimistic scenario for Starbucks, right? Matter of fact, we can be even more optimistic. What if we can get the tax rate even lower to 26%? And what if we can get the revenue higher to 14%. All right, now I'm at $74 a share. All right, so I'm getting really optimistic on Starbucks. I'm not saying this is going to happen. What I'm saying is, in a best case scenario, this is what could happen, right? And so what I'm saying is, if everything really goes for Starbucks, I think somewhere in the low to mid 70s is where their stock price could eventually be if everything really goes right and everybody's very optimistic and bullish about Starbucks. Okay, so I'm going to save this as my bull model. Questions about what I did or how I came up with those assumptions or why I came up with those assumptions? Yes? Well, that's what I'm saying. I'm trying to synthesize what I'm learning, and that's why I'm going through a lot of different data sources. I'm looking at past trends. I'm looking at industry research reports. To some degree, I'm looking at the press articles about what I read about Starbucks. I could look at what the competition is saying, because obviously Starbucks is competing against competitors. And I'm just trying to synthesize it all into reasonable assumptions. But what's most important, and it's subtle, but I want you to do what I'm doing, is you'll notice that I'm giving you rationale for why I'm changing every number. All right? I didn't just arbitrarily come up with 14%. All right? I'm giving you a rationale for how I got to 14%. All right? Which is basically these high-end stores and extra fast growth outside the U.S., particularly in Asia Pacific, which I then referenced the trend of high growth in Asia Pacific before to be even stronger for Starbucks. EBITDA margin, changing of the margin of Starbucks because they are getting into these premium products, which is going to give them even higher margins, which is why they're getting different margins than what they've gotten historically. And oh, by the way, tax rate lower because they're doing more international, which gives them more advantages of lowering that U.S. tax rate, which is otherwise very high. So I'm not just throwing out numbers, I'm giving rationale for the numbers, because that's one of the things that Morgan Stanley said was very important to institutional investors, is that when they give a range, they don't just give a range, they give a rationale for what's going to lead to the range. So here's my bull scenario. So in your write-up, your written assignment, this is what you're going to practice doing. Okay, so this is what I mean by writing up your assumptions. You've got to basically say why I'm changing the numbers to what I'm changing them are. Now, I'm not asking you to change every number in the spreadsheet, but nonetheless, these are the major categories that we're initially focusing on. Yes?
Can you very briefly just recap each of the changes? We had the growth.
So what I did was I changed in this video, which I'm recording, by the way, but I changed eventually growth rate. I double bumped it to eventually 14%.
But not until 2018.
But I didn't change 2016 and 17 because these were the consensus estimates for the next 2 years. So I still didn't change those. I really went for more of the out years. Okay? And then I changed the EBITDA margin to 26.5, which was even higher than what they did in 2017, where they got to 25 and much higher than their historical average. And then I went to the tax rate and I changed it down to 26%. And I got very aggressive on the tax rate and said it'll be even lower as they get more international and do much more efficient tax planning. Okay, and that got me to a share price of, and by the way, here on the assumptions tab, I left the CVG alone at 4.33%. Okay, which I already think is pretty reasonable, but nonetheless, I got to change that one too. But here's the idea: is right now I'm at a share price target of 73.62. So I'm calling that my bull. All right. Notice, by the way, what happens to our new ROIC chart. That is called a hockey stick. In finance, hockey sticks are bad, right? Because inevitably they rarely come true. So when you see, particularly for the out years, growth that goes up straight in the out years, and then I showed you earlier this. This Starbucks is doing this, and the bias should be this for maturing companies. All right? So again, I'm not saying Starbucks can't do this, but I'm saying that they would be an exception to a rule, and we would have to have a rationale for why this should be an exception. All right? And our rationale for this would have been, as we said, which is, all right, they're maintaining extreme competitive advantage. They're going to do really well in these markets compared to these other competitors. That's why they're going to grow faster than the industry. And that's why in competitive markets, they're going to get even better margins on their business because they're going to be able to establish the pricing to get those premium brands, right? But those are a lot of assumptions that go against what we typically see in the out years for maturing companies. So that's why I'm saying this is an important sanity check, which says to be at this price range, you have to have very aggressive ROICs, which means that the ROICs, instead of 40 to 50% operating ROICs, have to approach 65% operating ROICs, right? Which I'm just telling you, into infinity and beyond, hey, Buzz Lightyear, that's pretty hard, okay? So I'm not saying it's the right one. I'm just establishing the top end of my range. Bear. So now what I'm going to do is I'm going to go back to my as-is model. So where we started, File, Save As, and this is going to be my bear from the video. I'm going to save that. Okay. So now I go into the pessimistic mode. Okay. So what could go wrong for Starbucks, and how wrong could things really get? Okay. So again, same thing. Let's go back. Well, one of the things that could go wrong for Starbucks, they don't achieve the revenue growth rate. Right? That these very high-end premium stores, not very successful. Maybe in the test markets in some of the urban centers like Seattle or Boston or New York, Manhattan, maybe they do well, but they don't really do well as across the country and across the world. So the 1,000 stores don't really spur their growth. And maybe people are not willing to pay for super premium coffee. And people like Dunkin' and Panera and others, which have been more aggressively targeting Starbucks, actually have more of an impact on their ability to grow, and they start growing closer to the industry as opposed to growing much faster than the industry. Okay? So what I'm going to do is, starting in 2018, I'm going to start tamping down that revenue growth rate, and rather than doing it arbitrarily all at once, but I'm going to say it's going to go to 6% and then 5% and then 2%. And oh, by the way, 25%, which is the EBITDA margin forecast for the consensus 2017, is the best they've ever done. And if you look historically, they've been closer to 19 to 20s. So maybe if they go back to around 20 to 21% EBITDA margin, which is where they were historically, that's where they could actually end up in a slower growing market. So instead of 25, I'm going to say 24, dropping to 22, dropping eventually to 21. Or even 20. And tax rate stays at 32. Not getting any benefit of lowering their tax rate. Well, guess what? Now I'm at a $34 stock price. And oh, by the way, save that. As sad as that sounds, that actually matches more up with the McKinsey ROIC chart that I would expect. Because that actually shows me an operating ROIC that over time is heading towards the cost of capital as opposed to away from the cost of capital. So one could argue that that's very pessimistic, but the flip side is that's what I would actually expect for a maturing company in a toughening industry. Right? So I'm not saying Starbucks can't beat the odds, because Howard Schultz is a smart guy, right? And they got a tremendous brand, and they're selling an addictive drink, right? But nonetheless, this is what is a challenge for the business that could lead to a bear case scenario. So I just want you to understand, if you buy Starbucks, I'm telling you that your upside is mid-70s and your downside is mid-30s. Okay? That's what we're doing by establishing the range. And here's what gets me to the downside end of the range, right? Which is they get industry average growth for these reasons. They don't get the premium margins that they've been doing for these reasons. And that leads to the much lower share price. Questions about that, or what you're going to be writing if this were your project, writing that up in your project. Okay? So then we would save that as our bear. Finally, I go back to the as is. File, save as, target stock price, in this case for the video. Now, my opinion. Where am I on that range? All right? I've established bookends. On one end of the bookend, I'm about 35. On the other end of the bookend, I'm mid-70s. Along that continuum, where do I actually think Starbucks is going to fall? This is my opinion. By the way, if you go back to the analysts, today, ANR, like I said, 64, 66, 72, 65. You're not seeing complete agreement, but you're starting to see something. What's the difference between somebody picking 72 and somebody picking 65? Right? Well, what it really means to get to 72, which is close to our bull scenario, is they're the everything is going to go right analyst. They're the get even faster than 8.5% growth and get even better margins than 25% on an EBITDA basis going forward. That's how you get to 72, and that's what that analyst seems to be thinking is going to happen. Versus other analysts. Here's Jason West at Credit Suisse, which is at 58. This analyst is probably more likely to say, you know what? I think it's probably the current share price. About 8.5% growth, about 25% margins. Because that's what the as is. And right now they're at 54 and he's targeting close to 58. So that's what I'm saying. There's disagreement in the real analyst community about these assumptions of what those growth and margins are going to be in the future. So here's the point. What is your opinion? Because that's what we're putting into the target. Where are we? And the reason I want to show you this data again in Bloomberg is there's not a right answer here because you are predicting the future. And the way that you're going to be graded on this is not whether we agree or disagree, but whether or not you can follow the process and use reasonable assumptions and actual data to come up with a solution. Right? So you're going to be graded much more in the process than you are in the result. Right? But it has to be reasonable. Right? Because as I told the last class, you guys in this room, you're really good at plugging and chugging. Right? But it's no longer about solving the equation. It's about what assumptions did you put in to the equation and why did you use those assumptions? Because their assumptions are more important than the model itself. The math was the easy part. This is the hard part of valuation. It's the art of valuation, not the science. But the art is where the value is. So, back to this. Who has an opinion on this? Where do you think Starbucks is going to be? And I'd like you to talk about your opinion by coming here to the ratios and telling me what you think is reasonable for the growth rate and reasonable for the EBITDA margin, reasonable for the tax rate, reasonable for the CVG. So, anybody have an opinion on that they want to share? Give me some numbers and I'll change them. So what is the right revenue growth rate for Starbucks? What do you think? If you were telling a relative, a family member, with their own money, your family's money, would you tell them to buy, sell, or hold Starbucks? Based on your assumptions, what assumptions would you be making to give them that advice? What would you say about revenue growth? Because we've established what a bull and a bear could look like. And you see that most people are actually pretty optimistic on Starbucks in the real world. So you got to come up with your opinion. What do you think? Yep.
I think I'd probably place him more in a hold position just because the ROIC is kind of aggressive even in the as-is scenario.
Okay, so give me a revenue growth rate that you think you would use.
Maybe 9%.
All right, so you don't think you'd be too different from the 8.5? 9% for all 4 years, or would you trail it down after time, or what?
Maybe trail it down to 8.5 or 8.
So give me some numbers. 2018.
9, 9, 8.5, 8.
9, 9, 8.5, 8?
Yeah.
Okay. What about EBITDA margin? What do you think is going to happen to their EBITDA margin over time?
Probably once again pretty close to the as-is.
Okay.
I don't have any reason to change it from as-is.
So you leave that around 25.4. Okay. What about the tax rate? Okay. What about the continuing value growth assumption? It's around 4.3 when we started. on the assumptions tab, CVG. So this is the very, very long-term growth rate for Starbucks. We said it ended up being 4% because, as I said, the U.S. and Europe, we're probably looking at 2 to 3 for the long term, and Starbucks is growing more in Europe and Asia, and more in Asia and Latin America. But the other piece to this is that Starbucks is also not completely mature yet. They're growing at 8%. So I got to do that 8% with the long-term 2%, and like I said, the market right now is usually around 4.3. Do you think that's reasonable? Would you make it higher or lower?
I'd probably use a more conservative, like 3.5.
Okay. Well, when you do that, you're actually a sell. You're at 46.
That's still like in the holding range.
49's hold.
Okay.
So you're actually in the sell range. So maybe you thought 3.5 might be too aggressive. Maybe 4. Noticing compounding, 0.5% makes a big difference. But a little bit more conservative on the G. And now you're at 50, which is actually in the hold range. You're about 50. All right. But to be honest with you, that would actually be the most pessimistic of any analyst in the real world today, the share price. I'm not saying they're right, because we also haven't been dealing with all the industry information. We're not in the conference calls. We're not talking to the senior leaders of all these companies. So maybe they're getting more insight than we are. But I would also tell you that this is actually highlighting, though, what does Starbucks actually have to achieve? And even in this spreadsheet, in a DCF basis, with these relatively aggressive numbers, you're still saying that Starbucks today is pretty fairly priced. And it's going to be hard for them in the short term to justify a higher price. So that's what you're really coming up with when you say hold range. Is what you're really saying is, I think Starbucks is fairly priced in the low 50s. And so therefore, I don't see a lot of upside to Starbucks. The upside's already priced into the stock because the stock already includes a semi-rosy scenario. And oh, by the way, from an ROIC chart basis, it still assumes better performance even at 50 into the out years. So it's not like 50 is saying Starbucks isn't going to be doing that well. This actually says there's still an exception to the rule even at a $50 share price. So that's hold, right? Anybody on the sell side? Is anybody even more pessimistic about Starbucks? Anybody agree with the buys and are more bullish about Starbucks? Think the numbers should be much more aggressive than we have in here, closer to the bull scenario? I see that you're not a verbal group. That's why our next assignment's going to be in writing. So rather than doing this verbally, it's easier to just write 500-word essays. So we'll just keep doing the essays and skip the easier part of discussing this verbally in class. So with that in mind, let's talk about your assignment. So I will save and post these files as well as the YouTube video later today. So after the last class, around 5 o'clock, what you need to do is check your assignments tab, because Wednesday is a Bloomberg lab day, which means no physical class on Wednesday. You will use Bloomberg in the lab in order to do the assignments. I'm giving you lab time to do it, since obviously there's not enough terminals for everybody. And then our next class to discuss the assignment will be next Monday. So on Monday, it'll be due for all sections at 10 a.m. We'll discuss it, and then we'll get another company. Also next Monday will be industry selection day. So again, I'll give you an industry, and you'll pick a company in the real world in that industry, which your group project will be based on, and you'll start the more detailed analysis for your group projects. All right? So with that in mind, a couple of things. I'm going to give you another company. It won't be Starbucks, and it won't be a competitor of Starbucks. It'll be a completely different industry. Okay? And so what you'll have to do, just as a quick summary, is go to Bloomberg. You're still logged in. So let's say it's McDonald's. It won't be McDonald's, okay, for those watching the video, but this is just more representative if it were McDonald's. Then first thing you would do, and you can see this in Elms, under the file section for Starbucks, you need 3 screenshots. And I gave you ticker symbol, short code, and Bloomberg name as reference. So you need to go to the DES screen to get the shares outstanding. Okay. Then you would need to go to the WACC screen to get a current WACC for that company. So these are variables that you're going to enter into the Assumptions tab. WACC, shares outstanding, then EEO. You are going to then get from here the revenue and the EBITDA forecast for the next 2 years, and you're going to get the 2017 EV to sales and EV to EBIT to get the estimated margins. Okay, so that's how you're going to update the Assumptions tab. All right, and then you're going to come to the ratios. Oh, and by the way, you would have exported the model data. Okay, so you would go to McDonald's, you would go to FA, you would go to Custom, you would take the tab in Bloomberg you created that has the 6 years of historical data, you would output to Excel, you would dump this into Excel, you would also make sure that you got rid of any dashes with zeros, find and replace, because Excel is going to choke on the dashes when you export dashes. You'll then copy and replace this tab, copy, space, paste special values, the Starbucks model data tab with the data that's been exported with the new company's data, field for field. And then in the ratios, you would then do an as is to get to the current share price. So you get to type in the current share price. And more importantly, remember that these cells in yellow have been hard-coded in, which means I typed in the number 9 here, I typed in the number 25 here. If I were doing McDonald's, and let's say McDonald's is growing at 3%, that could cause a problem because it's going to go 339, okay, in terms of revenue growth rate. So what's going to be important is to undo these hard-coded numbers. So what I often will do is I'll just do an equal to previous year and copy and paste that, just so I don't have any random numbers that I changed before that are stuck in my models. Because what will happen is some of you are going to get some crazy valuations. And usually the crazy valuation is you forgot to change the share count, or you left in a margin from Starbucks when the company's margin I gave you is much lower, and suddenly with that high margin it creates a high share price, or high sales growth rate creates a high share price. So just be aware of that as you're going through the model, okay, to make sure that you undo these. But you're basically take the company individually, basically do this, update the model, come up with the as is, write up in a separate Word document your rationale for why you used the revenue growth rate, the EBITDA margin, the tax rate to create the as is, right? What assumptions you used and why. Then bull case scenario, write up the change in assumptions for the bull. Bear case model, write up the assumptions for the bear. Target, where you end up, write up your assumptions for the target, and that equals a buy, sell, or hold, and this is your final recommendation for the company. That is your next assignment, and a microcosm of your group project. Questions about that assignment? Yes? So that's a great question. I haven't, the question just for the video is, are you changing any of the numbers in the balance sheet assumptions? And the short answer is no, with a caveat. Any number you want to change, you're welcome to change. But here's the thing. Subtly, when we built this model last week, we tied everything as a percentage of revenue. Because everything is tied to a percentage of revenue, then the balance sheet is growing as the company grows, which is creating the concept of investment. So what we're implicitly assuming is constant productivity. So if we assume that the company's productivity stays about the same, which most people do, then you don't have to change the bottom numbers. The only time you would change the bottom numbers is if you see the productivity of a company drastically changing. Then the balance sheet may not grow at the same rate as the income statement, and then we would change the bottom numbers. But as you get started, that's why I'm saying focus on those three. You're welcome to do more, but let's just kind of practice at least with these three, is the way I would define this. Okay? Any other questions? These are good questions. Okay, so again, Wednesday, Bloomberg Lab Day. 1 week from today, back here, ready to discuss your solution. And that day, pick a company and then work on another company in the model. Okay? Have a great week. October.
Are you giving us the company to do this homework for?
Yes, I will give you the company. I'll tell you which company it is.
Okay.
So next week you will choose your company. This week I will tell you what the company is.
And when are you going to do that?
And 5 o'clock.
Okay.
After 5. It'll show up in the assignment
All
stuff.
right, thank you.
We choose our company for the assignment.
No, I'll give you the company for the assignment. Next week you'll choose your company for the group project. But for the assignment, I'll give everybody one. I just don't want people in later sections to do it during class. Which they will. So.
And then we're trying to give it to her anonymously, so trying to put it like in front of her.